Hey everyone, this is Cary. I'm excited to have my teammate Colin Frankenfield in the podcast booth with me. Colin joined Heritage last fall as Director of Investments. Colin, thanks for getting behind the mic with me this afternoon.
Thanks, Cary. Thanks for having me.
Yeah, it's been awesome to watch you hit the ground running and already make a positive impact, whether it be with the investment research, business development, or working directly with clients and the team. I thought it'd be fun to do a little Q&A session with you as a introduction of sorts to a larger audience. How does that sound?
Absolutely. Let's go.
Excellent. So thinking back to our initial conversations last year, I remember quickly sensing that your industry experience would put you in a strong position to be successful. Would you share with everyone a few highlights of where you've been, what you've done, and things you've learned along the way?
Yeah, absolutely. So I was fortunate to get my start, to start my career at General Electric at GE as an analyst in a training program where I invested across a very broad spectrum of companies, both in terms of business and investment type, everything from gas-fired power plants and solar farms to electric vehicle companies, and either as a first lien lender, majority shareholder, or venture capitalist. One of my favorite memories is underwriting a Series B venture investment for this little-known company called Tesla. The CEO of our group said the valuation was too high, although he loved the cars. We ended up passing on the investment, again, because the valuation was too high. But that was a really good lesson for me in that, not everything that's important to investing is in the financial model or the headline valuation. Since then, I've spent the last 10 years of my career as a public markets investor, most recently working for an absolute return long-short fund in Charlottesville. On the long side, we invested in opportunistic situations where we had a differentiated view as to why a company was misunderstood or underestimated. On the short side, we shorted bonds of companies with poor balance sheets and a disadvantaged business model. Some of the things I've learned along the way, how long do you have? But look, one thing that I do think about a lot is just how complex markets are. Well, a term I really like is this idea that markets are complex adaptive systems. The world is constantly changing and you have to be continually learning and re-underwriting your assumptions. It's a really hard thing to do in practice, this idea of strong convictions, but being willing to change your mind. And I'm still trying to figure out the right balance.
I really like that. In a way, trying to make the complex less complex and always having a forward-looking point of view.
That's exactly right.
Yeah, so unsurprising follow-on question. How did you hear about Heritage and what attracted you to the firm?
Sure. So I heard about Heritage through my network of family offices. And what attracted me to the firm was that as a public markets investor, many of our clients were family offices. And I found that whenever we would discuss our portfolio, inevitably the conversation would move to other sectors, asset classes, private equity, venture capital, et cetera. And I felt that there was a lot more value I could provide because of my background across both public and private markets. Also, the idea of building durable, high-quality portfolios that were focused on only the best companies and the best managers really resonated with me.
Awesome. I'm curious, now that you're a few months in, has there been anything about the firm that surprised you?
Yeah, biggest surprise, and I think it's a little bit of a pleasant surprise, is just learning how much people work together. I feel like we're really rowing in the same direction, and it's very easy to reach out to someone over Teams and immediately get a response. Just this culture of having an office in Pittsburgh and Charlottesville and Richmond, but even if you're not in the same office, you can, between the Teams calls and video calls, it feels like you're in the same room all the time. And then also just this idea of our culture is a culture of constant improvement. And I think everyone here is always trying to level up and work harder and get smarter because that's just the name of the game in this industry.
Yeah, I feel like you hit on just about every single one of our core values in that answer.
Unintentionally.
Whether it be the collaboration or passion or intellectual curiosity and integrity, of course, is table stakes. So, yeah, I couldn't agree more. So with both of us behind the mic, I think it'd be amiss not to touch on investment strategy a bit more. I've enjoyed collaborating with you on our investment process. What would you say are the 2 to 3 most important things you want clients to know about our market outlook and how we're positioned?
Yeah, absolutely. Well, I think I'll just take a quick step back and just talk about the last few years first. Over the last 5 years, the markets have been through a number of different regimes and cycles. which included significant interest rate and equity market volatility. And over the past 2 years, U.S. equity market returns have been very strong, primarily because of the strength in the technology sector and AI tailwinds. So in 2023 and 24, the Mag 7, which is Apple, Microsoft, NVIDIA, Amazon, Google, Meta, and Tesla, made up over half of the S&P 500's return. If it weren't for the Mag 7, the market would have only been up about 8 to 10%. Now, this is not to say that the performance of the Mag 7 is unjustified. We saw significant margin improvement and acceleration of earnings growth from these companies. But going forward, we believe there's a lot of risk, particularly concentration risk, from owning just the index. The 10 largest companies in the S&P 500 now represent nearly 40% of the index. In terms of the broader market and key takeaways from our portfolio positioning, I think there are a lot of things to be positive about. We have potential tax stimulus coming, an improved regulatory environment, possibility of more rate cuts between 1 and 2, strong corporate earnings, and a resilient economy. On the other hand, like I mentioned, market multiples and concentrations are at historical highs. Tariffs could be inflationary, and there are always unknowns. But to me, it feels like animal spirits are high, and the pendulum is much closer to optimism than pessimism. This doesn't necessarily mean that it's a bad time to own the market, especially if inflation continues to hold steady or fall, and we get an easing cycle. Since 1995, after rate cuts began, about 70% of the time, the market has been higher a year later. That being said, we have high conviction that a prudent level of diversification makes sense across passive exposure, indices, our core equity holdings, which we believe to be very solid companies with good growth rates, and then also an appropriate level of fixed income and alternatives. It's my belief that this is the best way to compound capital over the long term while reducing the risk of permanent impairment.
Yeah, I couldn't agree more. There's obviously a lot to unpack there, but the bottom line being trying to build high quality, differentiated portfolios, optimize the risk reward characteristics of those portfolios, develop these market views, and equally, if not more important, do so along with a deep understanding of the client's long-run wealth objectives, specific liquidity needs, tax situation, and any unique preferences they may have. So that's all good.
That's exactly right. You said it better than me.
I don't know about that. So probably have time for one more question, and maybe we could wrap up on a lighter topic. I've also enjoyed getting to know you on a personal level, Colin. You have a beautiful family. Seriously, one of my favorite holiday cards last season. Would you mind sharing a little?
Yeah, absolutely. And you know me well enough now. I probably talk too much about my family. So
that's not true at all.
If you ever want to, just tell me to stop. But so I have twin girls that are 9, they're fraternal, and they're very different. One likes ballet and one can throw a spiral football, right at my head. And then we have a 2.5-year-old son, Jamie, and they're the most fun thing in the world. A good story recently is we were playing hide and go seek on a very cold Saturday, and Jamie, who doesn't quite understand the concept of how to play hide and go seek, decided to just announce to everyone where he was whenever he was hiding.
Oh my goodness!
And so he always lost, but it made for a lot of fun and a lot of laughs. But yeah, they're I'm thankful for them every day.
Too funny. Thank you so much for sharing. And thanks again for joining me this afternoon. Thank you, everyone, for listening. Colin, the rest of the team, and I look forward to seeing you all soon. Thanks.
Thanks, Cary.